Alright, we're back live and direct. Hey everyone, welcome back to the channel. Today we're diving deep into how the ongoing Middle East unrest is directly impacting your money, especially the British pound, the UK government bonds and the London stock market. No geopolitics here, we're strictly focused on the financial side. Why the pound is stuck below $1.34, why gilt yields are climbing fast, why the FTSE 100 dropped to late March lows today, and what this means for your investments, savings and the wider UK economy. If you trade forex, hold UK stocks, or just want to understand how global events hits your wallet, this video is for you. Stick around to the end for the outlook and what you should watch next. Let's get into it. Right now, the British pound is holding steady just below $1.34 level against the US dollar. It's not crashing, but it's not gaining much ground either. The main reason? Rising energy costs, which are triggered by the Middle East tensions, higher oil and gas prices, which is feeding directly into the UK inflation. Investors are now pricing in at least a 25 basis point interest hike from the Bank of England in September, with a strong possibility of a second hike after that. When central banks are expected to raise rates, it actually supports the currency, which is why the pound isn't falling sharply despite the global risk-off mood. However, it's not all hawkish. Dovish Monetary Policy Committee member Alan Taylor, who voted in the 8-1 decision to hold rates back in April, came out today saying current interest rates are already quite restrictive and he sees no need for further tightening to control inflation. His comments are providing a bit of a counterweight in preventing the pound from breaking high either. Let's do a little deep dive into the GBP and US dollar. Let me break this down a bit further. The pound is steady below $1.34. That level has become important resistance. Every time it tries to push above, selling comes in. Why? Because while higher rates are supportive, the broader risk sentiment is cautious due to the Middle East situation. Energy prices are the key transmission mechanism here. The UK imports a lot of energy, so any disruption in global supply chains or shipping routes pushes the cost up. That feeds into a higher inflation expectations, which in turn makes the Bank of England job a bit more complicated. What does this mean for you? If you're traveling abroad this summer, your pound is buying you slightly fewer dollars. If you have US dollar assets or earn in dollars, this benefits you. Exporters, a weaker pound can help competitiveness, but only if it stays stable and doesn't become too volatile. But you know, we'll keep watching it at $1.34 as the key level. A clean break above could signal stronger BOE tightening expectations, while a drop below recent lows would show risk aversion is winning. Next up, we got the bond market. UK 10-year gilt yield have risen towards 4.95%, the highest level since May 21. When yields rise, it means bond prices are falling. Investors are demanding higher returns because they are worried about inflation staying stickier for longer. Again, the driver is those elevated energy costs coming out of the Middle East situation. Higher input costs for businesses and households is close to higher inflation prints expected later this year. This has big implications. Mortgage rates in the UK could stay higher for longer or even rise again. Government borrowing costs are going up, which eventually affects taxes and public spending. For investors in bonds or bond funds, this has been a tough period. Pension funds and institutions that hold gilts are feeling the pressure. Alan Taylor dovish comments are trying to calm this a bit, but the market is currently siding more with the inflation hawks. Now let's dive in deep into the FTSE 100 analysis, and we're going to look at the stock market reaction. Now let's talk about London stocks. The FTSE 100 had a volatile session. It reversed early gains, dropped as much as 0.7 to 10160, its lowest since March. Later in the day, it recovered slightly up around 0.2 to 10240, still trading near the 3-week lows. Why the weakness? Broad risk-off sentiment across Europe and US futures, especially in technology stocks, but UK specific stories also played a role. Travel and retail stocks took hits. Look at the WH Smith. The share price plunged nearly 16% to its lowest level since 2010. The company slashed its annual profit forecast for the second time in 2 months and announced an equity rise. They specifically mentioned travel disruptions linked to the current Middle East situation. This shows how real-world supply chain and travel impacts from higher energy costs and uncertainty are hitting company earnings directly. UK banks were also under pressure. HSBC is down around 2.1%. Standard Chartered is down 1.7%. Part of the JP Morgan note highlight risks from new Chinese regulations put the broader cautions mood from energy-driven inflation also weighed in on financials. Despite the sell-off, there was a late recovery in the FTSE on renewed hopes for progress in the Middle East talks. President Trump commented that a deal to reopen the Strait of Hormuz could be closed. A single comment helped lift sentiment because it raises possibility of reduced shipping disruptions and lower energy prices in the coming weeks. On the other side, Iranian Parliament Speaker Mohammad Bahir Ghalibaf, I hope I said that right, said Tehran will respond decisively and without delay to any aggression. These back and forth statements are keeping markets on the edge, creating short-term volatility but also opportunities when hope for de-escalation appears. This is a classic risk-on, risk-off trading. When hopes for resolution rise, energy prices ease, inflation fears drop, stocks in the pound recover. When fresh strikes or tough rhetoric appear, you get the opposite reaction. So what should you take away from today's moves? Number 1, energy. Energy is the main channel through which the Middle East unrest is affecting UK markets. Number 2, inflation expectations at the second round effect pushing BOE rate hike bets higher. The FTSE is showing selective weakness. Defensive and travel related stocks are suffering while others are more resilient. Number 4, volatility is elevated. We're seeing 0.7 to 1.4 daily swings, which is normal in this environment for investors. Diversification remains key. Energy sector exposure might benefit from higher prices in the short term. Watch gilt yields closely. If they break above 5%, it could pressure equities further. For GBP traders, $1.34 is the battleground level. Looking ahead in the next few days will be crucial. Any positive news on reopening shipping routes or successful talks could quickly ease energy prices and support the pound and FTSE. Conversely, any renewed escalations would keep inflation fears alive and pressure yields higher. I'll be tracking these levels closely and I will update you in the next video. Drop your thoughts in the comments. Are you long or short on GBP right now? Do you hold any UK stocks? What levels are you watching on the FTSE? If you found this helpful, smash the like button, subscribe, hit the bell so you don't miss the future updates.